If you're in public accounting, you've probably already thought about what comes next. Maybe not seriously yet, but the question is there. And if you're considering Big Four, one of the things people talk about constantly is the exit, where you go after, what the name gets you, what doors it actually opens. The problem is, most of the content on this topic is either vague or optimistic, in a way that isn't that useful. This video is the honest version, what the exits actually are, which ones are realistic depending on where you are in your career, and what you need to be doing now if you want a specific outcome later. The first thing worth saying is that leaving Big Four is not a failure. The firms know most people aren't going to make partner. The pyramid structure makes that math pretty clear. There are a lot more associates than there are partners, and that gap doesn't close by accident. The expectation, both culturally and structurally, is that a significant portion of the staff is going to exit at some point. That's not a bug in the system, it's more or less how it was designed. The typical window for exits at the associate level is somewhere in the 2 to 3 year range. Some people leave earlier, some later, but that's when the market for Big Four alumni tends to be most active and when a lot of people start seriously evaluating what they actually want. It's not always burnout driving it. Sometimes it's compensation. Sometimes it's a specific opportunity that comes along. Sometimes it's just the natural next move after you've gotten what you came for. What matters is that the exit you're able to take is largely determined by what you built while you were there, the clients you worked on, the skills you developed, whether you got your CPA, and the relationships you maintained. Most people don't think about that intentionally enough until they're already trying to leave. The most common exit from Big Four, by a significant margin, is industry accounting. Corporate accounting roles, financial reporting, FP&A, positions inside private or public companies that need people who understand how the financial statements actually work and have been through the scrutiny of an external audit. This exit is accessible at the associate and senior level without needing any additional credentials beyond what you're already building. Big Four experience signals something real to hiring managers in industry. You've seen more in 2 to 3 years than most industry accountants see in twice that time, and they know it. You're typically coming in above entry level, which means the compensation step-up can be meaningful even if the ceiling in some of those roles is lower than it would be on other paths. The trade-off, industry accounting usually means significantly better hours and more stability. It also means a slower pace in some environments, less variety, and in certain roles, a more limited upside if you're optimizing purely for compensation growth. For a lot of people, that trade-off is exactly what they want. For others, it's not enough. Knowing which camp you're in before you exit matters. Less common than industry accounting, but not rare, especially for audit professionals who have had deal exposure or who worked on clients in financial services. The CPA combined with Big Four experience is a credible path into transaction advisory, valuation, or in some cases, investment banking, particularly at the middle market level. The key variable here is what you did while you were at Big Four. If you were doing standard audit work on commercial clients, the path to IB is harder and usually requires an intermediate step. If you were in a transactions advisory or deals practice, or working on financial services clients where the work was closer to the finance side, the transition is more direct. Compensation on this path is the highest of any of the exits, and so is the workload. If you're leaving Big Four because the hours were unsustainable, moving into investment banking is not the solution to that problem. But if you're optimizing for earnings trajectory and you have the right background, it's a legitimate path that Big Four experience supports. This is the exit that gets talked about the most aspirationally and pursued successfully the least, at least directly from an audit role. Breaking into the investing side of PE or VC directly from Big Four audit is difficult. It happens, but it's not a common path, and it usually requires a specific combination of deal exposure, network, and positioning that most associates don't have coming out. What is more accessible is the operational and finance side of private equity. Fund accounting, portfolio company CFO tracks, financial operations roles at PE-backed companies. Those roles value the CPA and Big Four experience heavily, and they can be a legitimate entry point into the ecosystem even if you're not on the investing side directly. Venture capital is similar. The investing roles are hard to access without a specific background, but finance and operations roles at venture-backed startups are very accessible for Big Four alumni and can offer equity upside that traditional accounting roles don't. For people who like the client-facing side of Big Four, but want more focused or specialized work, Consulting and advisory is a natural exit. This covers a wide range: management consulting, risk advisory, IT consulting, SOC and compliance work, cybersecurity advisory, internal audit consulting. Boutique firms in these spaces actively recruit Big Four alumni. The brand carries real weight in that market, and the client management and technical skills you build in Big Four translate directly. Compensation can be similar to or better than what you are making, and the work tends to be more specialized, which is appealing if you found Big Four generalist work less engaging than you expected. SOC and compliance specifically is worth calling out. It's a growing area. The demand for people with public accounting backgrounds is real, and boutique firms doing that work are often more accessible than the larger consulting shops. This one doesn't get talked about enough. Leaving Big Four doesn't have to mean leaving public accounting. Regional firms, mid-size firms, and boutique practices are a legitimate exit that a lot of people overlook because the conversation always focuses on going to industry or finance. The trade-off is usually better hours, a more manageable culture, and more direct client relationships, sometimes at a modest compensation reduction, sometimes not. If you like the technical work and the client interaction, but found the Big Four environment specifically to be the problem, a smaller firm solves that without requiring you to reinvent your career. Niche practices, SOC audits, IT audit, specialty compliance work, are growing at smaller firms, and they're actively hiring people with Big Four backgrounds. If you're building towards something specific in that space, it's a more direct path than going to industry and trying to pivot back later. The exit you can realistically pursue when you're ready to leave is largely a function of decisions you made during your time at Big Four, not decisions you make when you're already trying to leave. CPA status matters. Most of the exits that carry meaningful compensation upside, corporate finance, advisory, senior industry roles, are easier to access with it than without it. Client exposure matters. The types of clients you worked on and the complexity of the engagements you were part of shapes what you can credibly talk about in interviews. The type of work matters. Audit, advisory, tax, and IT audit all open slightly different doors. Networking during your time is probably the most underrated factor. Most exits don't happen through job boards. They happen through someone you worked with, a client contact, or a connection made during your time in the industry. The people who exit well usually had those relationships already in motion before they were actively looking. The practical implication: if you have a specific exit in mind, work backward from it now. The choices you make in the next 12 to 18 months will either expand or limit your options when you're ready to move. Big Four was built to be a launch pad. Most people use it as one. The brand opens real doors, but it doesn't open all doors equally, and it doesn't open them forever. The window where Big Four experience is most marketable is roughly the first few years after you leave. After that, what you did after Big Four starts to matter more than the fact that you were there. The exit you want should be influencing how you work today. Not in a way that makes you less effective at your current job, but in a way that makes you intentional about what you're building. Skills, credentials, relationships, and exposure. Those are the things that translate into options. Most people who leave Big Four don't regret the decision. Most people who stay significantly longer than they intended to wish they had moved earlier. That's not universally true, but it's the pattern. Knowing what you want and moving toward it deliberately is almost always better than waiting to figure it out. That's the honest breakdown of Big Four exit opportunities, what they actually are, and what determines which ones are available to you. If you want more on building a career in public accounting and figuring out where it takes you, more videos are below. Subscribe if this was useful.